In this video, we'll break down 3 tech stocks that Wall Street is quietly buying right now as the S&P 500 pushes into historic territory above the 7,500 milestone. These are deeply embedded technology businesses powering AI infrastructure, cloud computing, networking, industrial automation, and the digital backbone of the global economy. What makes this group interesting is that each company already dominates critical parts of the technology ecosystem, yet many investors still underestimate how important they could become over the next decade. While retail investors chase the loudest names in the market, institutional money has been steadily flowing into businesses with durable cash flow, pricing power, and long-term compounding potential. The first stock on this list is Broadcom Inc., ticker symbol AVGO. Broadcom is one of those companies that quietly sits underneath the modern digital economy. Most consumers rarely think about the company directly, yet its technology touches data centers, AI servers, broadband infrastructure, smartphones, enterprise software systems, and cloud computing platforms used by billions of people every single day. This is exactly why long-term investors continue paying close attention to the business. Broadcom is not simply a semiconductor company. It is increasingly becoming an infrastructure technology powerhouse with multiple layers of recurring revenue and strategic importance across the AI ecosystem. And that distinction matters because many semiconductor companies are cyclical. Broadcom has been evolving into something much more resilient. The company operates in 2 major segments. The first is semiconductors. The second is infrastructure software. Together, those businesses create an incredibly diversified technology machine that benefits from several megatrends at once. On the semiconductor side, Broadcom produces chips that are essential for networking, connectivity, data transfer, wireless communication, and AI infrastructure. As cloud computing demand rises and AI workloads become more intense, hyperscale data centers need faster networking, faster switching, and more efficient movement of massive amounts of data. That is exactly where Broadcom thrives. AI models require enormous computing power, but many people overlook the fact that AI also requires enormous data movement. Servers must communicate with each other at extremely high speeds. Data centers need networking architecture capable of handling gigantic workloads efficiently. Broadcom has become one of the most important companies enabling that transition. This creates a very powerful long-term growth driver. One reason institutional investors have been accumulating Broadcom shares is because the company is directly benefiting from explosive AI infrastructure spending without relying on consumer hype. While many investors focus entirely on flashy AI software companies, Broadcom makes critical hardware that powers the infrastructure underneath the AI revolution itself. And infrastructure businesses often become extremely valuable because they are difficult to replace once integrated into large-scale systems. Broadcom's custom AI accelerators and networking products have become increasingly important to major cloud providers building advanced AI systems. These products help customers optimize performance, reduce power consumption, and scale their operations efficiently. That last point is especially important. Power efficiency is becoming one of the biggest issues in AI infrastructure. Training and running advanced AI models consumes enormous energy. Data centers are under pressure to increase computing power without allowing energy costs to spiral out of control. Broadcom's technology helps address that challenge. This gives the company a very strong competitive position moving forward. But Broadcom's story is not just about semiconductors. The company also built a major infrastructure software business through acquisitions. This part of the business adds another layer of stability because software revenues tend to be recurring and predictable. Enterprise customers often depend heavily on these systems, making switching costs very high. That creates a sticky customer base. Broadcom's acquisition strategy has been particularly interesting because management has focused on buying mission-critical software assets used by large enterprises. Instead of chasing trendy consumer platforms, the company targets infrastructure systems deeply embedded inside corporate operations. These are businesses customers cannot easily abandon. One of the most important developments for Broadcom was its acquisition of VMware. This dramatically expanded the company's role in enterprise infrastructure software and cloud computing environments. VMware technology is deeply integrated into how businesses manage virtualized computing systems, cloud infrastructure, and enterprise workloads. This acquisition potentially transforms Broadcom into an even more diversified technology giant with stronger recurring revenue streams. And Wall Street has been paying attention. Investors are increasingly viewing Broadcom as a hybrid company combining high-growth AI exposure with stable enterprise software cash flow. That combination is very attractive because it reduces dependence on a single revenue stream while still allowing strong participation in some of the fastest-growing technology trends in the world. Another reason institutions like Broadcom is profitability. Many fast-growing technology companies generate exciting headlines but weak profits. Broadcom is different. The company has consistently demonstrated strong margins and robust free cash flow generation. This matters enormously in today's market environment because investors are rewarding businesses that can both grow and generate substantial earnings. Broadcom has shown it can do both. The company has also developed a reputation for disciplined capital allocation. Management has historically focused on returning capital to shareholders through dividends while continuing to invest aggressively in growth opportunities. That balance appeals to long-term investors. Broadcom's dividend growth has been especially impressive. Over time, the company has built a reputation as a serious dividend growth story within the technology sector. That is relatively uncommon because many tech companies prioritize expansion over shareholder returns. Broadcom has managed to pursue both simultaneously. And that creates an interesting profile for investors looking for a combination of growth and income. Another key factor supporting the stock is the company's deep relationships with large enterprise and hyperscale customers. These relationships are not easily replicated. Once Broadcom products are integrated into massive data center environments and networking systems, customers are unlikely to switch providers unless absolutely necessary. This creates long-term pricing power and customer retention advantages. The barriers to entry in this industry are also extremely high. Designing advanced networking chips and infrastructure semiconductors requires enormous research spending, engineering expertise, and long development cycles. New competitors cannot simply appear overnight and challenge Broadcom effectively. That creates a durable moat. And in investing, durable moats matter because they protect long-term profitability. Another important point investors should understand is that Broadcom is benefiting from several technology trends simultaneously, not just one. The company is exposed to AI infrastructure growth. It is exposed to cloud computing expansion. It benefits from increasing global data consumption. It benefits from enterprise software demand. It benefits from networking upgrades across data centers. And it benefits from the long-term digital transformation of global businesses. When one company participates in multiple secular trends at the same time, the compounding effect can become extremely powerful over a decade or longer. This is part of the reason Wall Street continues showing confidence in the stock even after strong gains. Many investors make the mistake of assuming a stock cannot continue climbing after a big run. But truly dominant businesses often continue outperforming for years because earnings growth eventually catches up with valuation concerns. That is something investors should keep in mind when analyzing Broadcom. The company's recent financial performance has also reinforced the bullish thesis surrounding the business. Broadcom has continued reporting strong AI-related demand and expanding infrastructure opportunities. Investors have been particularly encouraged by management commentary surrounding AI networking and custom accelerator demand. That suggests the AI spending cycle may still be in its earlier stages rather than nearing completion. And that possibility is important because technology infrastructure build-outs often last far longer than people initially expect. Think about cloud computing. The cloud transformation did not happen in 1 or 2 years. It unfolded over more than a decade and created enormous winners along the way. AI infrastructure may follow a similar pattern, especially as businesses globally race to integrate advanced AI systems into their operations. If that happens, Broadcom could remain one of the biggest beneficiaries. Another thing that makes Broadcom interesting is management execution. The company has consistently demonstrated the ability to integrate acquisitions, expand margins, and focus on high-value segments of the market. Investors often underestimate how important strong management is in complex technology industries. Technology changes quickly. Capital allocation decisions matter enormously. Strategic mistakes can destroy shareholder value very fast. Broadcom's leadership has generally avoided those mistakes. Instead, management has focused on scalable, mission-critical technologies with strong pricing power and enterprise demand. That disciplined approach has helped the company build one of the strongest operating models in the semiconductor and infrastructure software industries. Now let's talk valuation psychology for a moment. Many investors hesitate to buy quality businesses because they assume the stock already moved too much, but elite companies often appear expensive throughout much of their growth cycle because the market continuously underestimates how large the business can eventually become. This is especially true when a company operates in rapidly expanding markets like AI infrastructure and cloud computing. The key question is not whether Broadcom is cheap relative to where it traded years ago. The key question is whether the company can continue compounding earnings, free cash flow, and strategic importance over the next 5 to 10 years. And many institutional investors clearly believe the answer is yes. Another hidden strength for Broadcom is diversification across customers and industries. Unlike companies heavily dependent on a single product category, Broadcom operates across several technology ecosystems simultaneously. That diversification can help stabilize results during different economic cycles. For example, enterprise software revenue may remain resilient even if semiconductor demand temporarily slows. Networking infrastructure growth may offset weakness in another segment. This layered business model provides flexibility that many technology companies simply do not have, and investors value resilience more than ever right now. Markets have become increasingly focused on companies capable of navigating uncertain macroeconomic environments while still maintaining growth momentum. Broadcom fits that profile better than many investors realize. There is also the geopolitical angle. As countries and corporations increasingly prioritize technology infrastructure and AI leadership, strategic semiconductor and networking providers become more important globally. Governments, cloud providers, and enterprises all understand that advanced computing infrastructure is becoming essential for economic competitiveness. Broadcom sits directly in the middle of that transformation. That strategic relevance could become even more important over the next decade. Now, no investment is risk-free. Broadcom still faces risks related to semiconductor cycles, integration challenges, competition, and broader economic conditions. Technology spending can fluctuate during recessions, and large acquisitions always carry execution risks. But when investors evaluate the company, they also see a business with scale, profitability, recurring revenue expansion, AI exposure, and strong competitive positioning across critical technology infrastructure markets. That combination is difficult to ignore. And that is why Broadcom continues attracting attention from serious long-term investors as the broader market reaches new highs. The market often rewards businesses that quietly become more essential over time. Broadcom fits that description almost perfectly. It may not always dominate retail investing headlines every day, but behind the scenes the company has become deeply embedded in the future of AI infrastructure, enterprise software, networking, and cloud computing, and Wall Street clearly understands that. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock Wall Street is quietly accumulating right now is Analog Devices Inc., ticker symbol ADI. Analog Devices is not the kind of company dominating social media investing conversations every day. It does not generate flashy consumer headlines or viral excitement. But what makes this business so interesting is that it sits at the intersection of some of the most important technological transformations happening globally right now. And unlike many speculative technology stories, Analog Devices already has a deeply established business with strong profitability, sticky customer relationships, and critical technology embedded across industrial systems worldwide. To understand why investors care about Analog Devices, you first need to understand what the company actually does. Analog Devices specializes in analog and mixed-signal semiconductors. These chips help convert real-world information like sound, temperature, motion, pressure, light, and electrical signals into digital data that machines and computing systems can process. That function is far more important than many investors realize. In the modern economy, almost everything is becoming connected, automated, intelligent, and data-driven. Factories are becoming smarter. Vehicles are becoming more advanced. Industrial systems are becoming increasingly automated. Healthcare devices are becoming more sophisticated. Energy infrastructure is becoming more digitized. All of those systems require highly precise sensing and signal processing technology. And that is exactly where Analog Devices dominates. This is one of the reasons institutional investors continue viewing the company as a long-term compounder rather than just another cyclical semiconductor stock. The company operates in markets with extremely long product cycles and high switching costs. Many of its chips become deeply integrated into industrial machinery, automotive systems, medical equipment, aerospace infrastructure, and communication systems that remain operational for years or even decades. Once those systems are designed around Analog Devices technology, customers are unlikely to switch suppliers unless absolutely necessary. That creates a durable competitive moat. And in investing, durable moats often separate short-term hype from long-term wealth creation. One of the most attractive aspects of Analog Devices is the quality of its customer base. The company serves industrial companies, automotive manufacturers, healthcare providers, communications infrastructure operators, and defense-related industries. These are mission-critical environments where precision, reliability, and performance matter enormously. Customers in these industries do not simply choose the cheapest supplier. They prioritize reliability because equipment failures can create massive operational and financial consequences. That allows Analog Devices to maintain strong pricing power. Another reason Wall Street likes the company is because industrial and automotive markets are becoming increasingly semiconductor intensive. Modern vehicles contain far more semiconductor content than older generations. Electric vehicles require advanced power management systems, sensing technologies, connectivity solutions, and battery optimization systems. Autonomous driving technologies further increase semiconductor demand. Analog devices benefits directly from those trends. Industrial automation is another major growth driver. Factories around the world are adopting automation systems, robotics, intelligent sensors, and AI-powered industrial technologies to improve efficiency and productivity. These systems rely heavily on accurate data collection and signal processing. That creates long-term demand for analog devices products. And unlike some semiconductor companies heavily dependent on consumer electronics cycles, analog devices benefits from industries with longer investment horizons and more stable infrastructure spending patterns. That can help smooth volatility over time. Another hidden strength for the company is engineering expertise. Analog semiconductor design is extremely complex and difficult to replicate. Many investors focus heavily on digital processors and AI chips while overlooking how challenging analog engineering actually is. Precision matters enormously in analog systems. Small errors can create major performance issues in industrial equipment, medical systems, communications infrastructure, and automotive applications. Analog Devices has spent decades building deep technical expertise in these areas. That expertise creates high barriers to entry. And barriers to entry matter because they protect profitability and market share over long periods of time. One thing investors should also appreciate about Analog Devices is the company's diversified end markets. The business is not overly dependent on one single customer category or one narrow technology trend. Instead, the company participates across industrial automation, automotive systems, healthcare technology, communications infrastructure, aerospace applications, and energy systems. This diversification provides resilience. If one market experiences temporary weakness, strength in another segment can help offset the impact. That flexibility becomes especially valuable during uncertain economic periods. Another major reason institutional investors are accumulating ADI shares is the long-term trend toward intelligent infrastructure. The world is becoming increasingly sensor-driven. Smart factories rely on sensors. Autonomous systems rely on sensors. Modern medical devices rely on sensors. Energy infrastructure relies on sensors. Advanced communication systems rely on sensors. And all of those sensors generate analog signals that must be converted into usable digital information. That fundamental trend could continue for decades. This positions Analog Devices to benefit from broad technological transformation without depending on speculative consumer trends or temporary hype cycles. The company also generates impressive profitability metrics compared to many semiconductor peers. Investors appreciate businesses capable of maintaining strong margins because it demonstrates pricing power, operational discipline, and product differentiation. Analog Devices has historically performed well in those areas. Strong free cash flow generation also gives the company flexibility to invest in research, acquisitions, and shareholder returns while maintaining balance sheet strength. That financial stability becomes increasingly important during volatile market environments. Now let's talk about AI for a moment because AI is indirectly helping companies like Analog Devices in ways many investors overlook. As industries adopt AI-powered systems, they require more accurate data collection from the physical world. AI models are only as useful as the data flowing into them. Sensors, signal processing systems, and industrial monitoring technologies become increasingly valuable in intelligent environments. That creates another potential tailwind for Analog Devices over time. The company may not be the loudest AI stock in the market, but it quietly enables many of the systems feeding information into intelligent technologies, and enabling infrastructure businesses often become extremely valuable over long periods. Another important factor supporting Analog Devices is management consistency. The company has historically focused on disciplined execution, long product cycles, and high-quality industrial markets rather than chasing every short-term technology trend. That strategy has helped build a business with strong customer loyalty and durable profitability. Investors often underestimate the value of consistency in the semiconductor industry. Technology cycles can be volatile. Demand fluctuations can create uncertainty. But companies with strong engineering capabilities, diversified end markets, and disciplined management often outperform over the long run. Analog Devices fits that profile well. the company also benefits from global infrastructure modernization trends. Governments and corporations worldwide continue investing in energy systems, industrial upgrades, telecommunications infrastructure, transportation modernization, and advanced manufacturing capabilities. All of those areas require sophisticated sensing and signal processing technologies. That creates long-term structural demand drivers for analog devices products. And because these infrastructure projects often span years rather than months, they can create more durable revenue opportunities compared to short consumer product cycles. Another thing investors should understand is that analog devices is not competing primarily on hype. It competes on precision, reliability, engineering quality, and long-term customer relationships. Those characteristics may not generate flashy headlines every day, but they often produce highly durable businesses capable of compounding shareholder value steadily over time. That is one reason institutional investors continue holding and accumulating shares even during periods when semiconductor sentiment fluctuates. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move to the third stock on this list, which is Applied Materials, Incoter's ticker symbol AMAT. Applied Materials is one of the most important companies in the global semiconductor supply chain, yet many retail investors barely understand how critical the business actually is. This company helps make the semiconductor industry possible. Applied Materials produces equipment, software, and services used in semiconductor manufacturing. In simple terms, the company builds the advanced machinery required to manufacture modern chips. Without companies like Applied Materials, advanced semiconductors simply would not exist at scale. That makes the company incredibly important in the AI era. As demand for advanced chips rises, semiconductor manufacturers need more sophisticated fabrication equipment capable of producing increasingly complex designs. The race for smaller, faster, and more energy-efficient chips requires enormous manufacturing precision. Applied Materials sits directly inside that process. This creates a very powerful long-term opportunity because semiconductor demand is expanding across multiple industries simultaneously. AI infrastructure requires advanced chips. Cloud computing requires advanced chips. Automotive systems require advanced chips. Industrial automation requires advanced chips. Consumer electronics require advanced chips. And global digital transformation continues increasing semiconductor intensity across the economy. Applied Materials benefits from all of it. One reason Wall Street likes the company is because it operates in a highly specialized industry with massive technological barriers to entry. Building semiconductor manufacturing equipment is extraordinarily difficult. It requires decades of engineering expertise, deep customer relationships, and enormous research investment. Very few companies in the world can compete effectively at this level. That creates a strong competitive moat. Another major strength is the company's exposure to long-term semiconductor capital spending growth. As chipmakers race to expand production capacity and develop next-generation technologies, they must continually invest in advanced manufacturing equipment. Applied Materials directly benefits from that investment cycle. And the AI boom is accelerating this process. AI applications require increasingly powerful semiconductors with higher performance and lower energy consumption. Producing those chips requires more advanced fabrication technologies, which increases demand for sophisticated manufacturing equipment. That positions Applied Materials very well moving forward. Another thing investors appreciate is the company's broad exposure across semiconductor manufacturing stages. Applied Materials participates in multiple parts of the fabrication process rather than relying on one narrow niche. This diversification strengthens the business model. The company also generates substantial service revenue from maintaining and supporting installed equipment systems. That recurring revenue component helps stabilize the business and deepen customer relationships over time. Once semiconductor manufacturers integrate Applied Materials equipment into fabrication facilities, ongoing support and maintenance become essential. That creates long-term customer dependence. Another important point is geopolitical relevance. Governments globally increasingly view semiconductor manufacturing as strategically important. Countries are investing heavily in domestic chip production capabilities to strengthen economic security and technological competitiveness. That trend could support long-term semiconductor equipment spending. Applied Materials stands to benefit because expanding fabrication capacity requires advanced manufacturing tools and infrastructure. And as semiconductor technology becomes more sophisticated, the complexity and value of these tools continues rising. This creates pricing power opportunities for leading equipment providers. Applied Materials also benefits from the fact that semiconductor innovation is becoming increasingly difficult and expensive. Producing cutting-edge chips now requires extraordinary manufacturing precision at microscopic scales. That complexity favors established industry leaders with deep technical expertise, and Applied Materials has spent decades building exactly that kind of expertise. Another reason institutional investors remain bullish is the company's financial profile. Applied Materials has historically generated strong cash flow and profitability while maintaining leadership positions in critical semiconductor manufacturing technologies. That combination attracts long-term investors seeking exposure to semiconductor growth without relying solely on consumer-facing chip companies. The company effectively provides picks and shovels for the semiconductor industry itself, and historically, infrastructure providers in major technological revolutions often become some of the strongest long-term winners. As AI adoption accelerates globally, semiconductor manufacturing demand could remain elevated for years. That possibility creates a powerful long-term setup for companies deeply embedded in semiconductor production infrastructure. Applied Materials fits that thesis almost perfectly. Now, when you step back and look at all four companies discussed in this video, a very interesting pattern emerges. None of these businesses depend primarily on hype. Instead, they operate underneath the digital economy itself. Broadcom powers AI infrastructure and enterprise systems. Cisco powers networking and secure connectivity. Analog Devices powers intelligent sensing and industrial automation. Applied Materials powers semiconductor manufacturing infrastructure. These are foundational technology businesses, and foundational businesses often become some of the market's most durable long-term compounders because the world increasingly depends on their products and services over time. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now here is the big question for you. Which of these four companies do you believe has the strongest long-term competitive advantage over the next decade? And which business do you think is most essential to the future of AI infrastructure and global digital transformation? Let me know your thoughts down in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.